Hello, and welcome to our webinar on the consequences of emigrating from South Africa. I am Victoria Lancefield, a global tax specialist from SAIL International. Today, we will be discussing all the ups and downs of leaving South Africa and how it will affect you from a tax perspective. We encourage active participation in our webinars, so please feel free to submit your questions in the chat throughout the webinar, and we will address them during the Q&A session at the end. Before we dive in, please note that the information provided in this presentation is generic advice. For specific tailored guidance, we strongly recommend seeking further professional advice. Any references to legislation are based on SAIL International's interpretation as of the date of this webinar. Here's what we will be covering in today's session. We will go through determining tax residency in South Africa, the application of the double tax agreement rules, foreign income protection, the process of breaking tax residency, drawbacks of breaking tax residency, benefits of breaking tax residency, any other considerations and any foreign tax obligations that might arise, and also returning to South Africa after having immigrated. Let's dive right in. Determining tax residency in South Africa. To effectively manage international tax matters, it's crucial to understand the varying approaches different countries or jurisdictions, as we refer to them, take towards taxation. Firstly, I want to clarify, tax residency is how a country will consider what you can be taxed on, not what visa you're on. The three main tax systems that exist are residency-based tax system, citizenship-based tax system, and source-based tax system. Let's start with the residency-based tax system. This taxes individuals and entities based on their tax residency status. Tax residents are required to report and pay taxes on their worldwide income, whilst tax non-residents, are only taxed on income earned within the borders of that country. Each country has their own set of rules or criteria that determine your tax residency status. Citizenship-based system. Under this system, taxation is determined by an individual's citizenship or nationality rather than their place of residence. Citizens are taxed on their worldwide income regardless of where they live or earn their income. This can create complex tax situations for expatriates who may be liable for tax in multiple jurisdictions simultaneously. For instance, the United States employs a citizenship-based tax system, meaning that US citizens must file and pay taxes on all their global income, irrespective of their current country of residence. Source-based tax system, which is our third type of tax system, is focused on the location where the income is generated or sourced. Under a source-based tax system, individuals and entities are taxed only on income that is earned within that country, whilst income earned outside the country is generally not subject to local taxes. So it is important to distinguish between the three tax systems and know which one your jurisdiction is covered by, so as to understand how you're going to be taxed and treated. South Africa is a tax residency-based system, so is pretty much most of the world. The citizenship-based tax system is only United States and Eritrea that are left with that tax system, and there are several source-based tax systems, however, not as many as residence-based tax systems around the world. In South Africa, as we are a residency-based tax system, you will be taxed on your worldwide income if you're a tax resident, and on local income if you're tax non-resident. Now, in South Africa, the burden of proof lies with the taxpayer, who must demonstrate any change in their status, meaning that even if you meet all the criteria to break your tax residency, it is not automatically changed. You need to apply a formal application with SARS. As such, in South Africa, if you're noted a tax resident, you are subject to tax on all your global income. However, if you're tax non-resident, you'll only need to pay tax on income that is sourced within South Africa. Let's talk about the factors that affect tax residency status in South Africa. In South Africa, we have two main tests in legislation that determine your tax residency status. We have the ordinarily residence test. This is subjective and considers whether South Africa is your habitual home. And then we have the physical presence test, which is a secondary test. This is objective and is based on the number of days spent in South Africa. If you're in the country for 91 days or more in the current tax year, and for more than 91 days in each of the preceding 5 years, you might be considered a tax resident. They're both complex tests that need to be assessed with caution and applied correctly when determining someone's tax residency. The ordinarily residence test is considered first and the physical presence test second. In basic terms, if you have a permanent intent to reside out of South Africa, then you will most likely be able to seize your tax residency by the ordinarily residence test. When you are considered a tax resident in two different jurisdictions, the double tax agreement, or known as the DTA, between those jurisdictions typically includes a residency article to help resolve the issue of which country has the primary taxing rights over your income. For example, imagine you're a tax resident in both South Africa and France. According to the DTA between these two countries, they would determine your residency based on an if test. So firstly, they will look at your permanent home. So it's permanent home test. You'll be considered a resident where you have a permanent home. If you have one in both countries, they'll assess your personal and economic ties. So test one is a no, you have one in both, you move on to the next one. Central vital interests, that is the second test. Residency will be based on which country you keep your key personal and economic connections. If still they cannot determine it on that, if you have key connections in both, then you move on to the third test, being the habitual abode test. If this one is unclear, then it will be determined by where you spend most of your time. If that is still unclear, say you spend 6 months of the year in France, 6 months of the year in South Africa, you want to avoid the winters, I wouldn't blame you. Then we move on to the nationality test. If all else fails on the above test, residency will be based on your nationality. Most times that will be looked at as your citizenship status. Do you hold a passport in both? If you do, then it will be going to the final stage of the article in that double taxation agreement, which will be the mutual agreement. If nationality doesn't resolve it, or all the other tests don't resolve it, authorities of both countries will then reach an agreement between them of who will have taxing rights for you in that specific tax year. These steps help clarify which country has taxing rights, and they will prevent double taxation. Through this webinar, I will be busting some myths and misconceptions that exist around tax residency. Let's move on to the first one. The first myth that I want to bust is that a common misconception is that renouncing South African citizenship, so giving up your South African citizenship, no longer holding that green mamba, will automatically make you a tax non-resident. Unfortunately, that is not true. You must still meet the criteria outlined in South African tax laws to change your tax residency status. As we said, your citizenship and your tax residency are not aligned in South Africa. It is a tax residency-based system, not a citizenship-based system. Formal notification to SARS and the submission of required documentation are necessary to seize your tax residency. It doesn't automatically happen. Let's talk about these DTAs, double taxation agreements, that exist between various jurisdictions. These are crucial for anyone earning income across borders. So let's dive into what exactly a DTA is. A double tax agreement is a treaty between two countries that prevents the same income from being taxed twice. Sounds straightforward, right? But there's a catch. DTAs don't automatically apply. Just because a DTA exists between the two countries, it doesn't mean you're automatically protected from double taxation. You often need to apply or claim the benefits under the DTA when filling your tax returns. And local tax laws will often override the DTA in certain situations and limit the application of the DTA. For example, even if a DTA limits or eliminates withholding taxes on certain types of income, like dividends or royalties, the local tax laws might still require you to withhold and pay taxes up front before you can apply for a refund or a reduction based on the DTA. South Africa has double tax agreements with about 42% of the world's countries. These treaties are designed to make cross-border taxation smoother, but you still need to navigate for your situation. So while DTAs are incredibly helpful, they require some work to ensure you're taking full advantage of their benefits. Let's move on to foreign income protection. As mentioned already, as tax residents in South Africa, you are legally required to declare and be liable for tax on your worldwide income. However, there are specific exemptions and allowances that can help reduce your tax burden on foreign income. First, we have the foreign employment income exemption. If you're a South African tax resident providing services abroad, you may qualify for an exemption under Section 10102 of the Income Tax Act, commonly referred to as the foreign income exemption. The eligibility criteria is that you need to render services outside of South Africa for more than 183 full days within a 12-month period. So that's a 12-month period, not necessarily the tax year period. You need to ensure that 60 of those days are continuous. Please note that the exemption limit, the first 1.250 million, so 1,250,000 rand of your foreign employment income is exempt tax in South Africa if you meet the criteria mentioned. Please note that this applies strictly to employment earned income. Okay, so employer-employee relationship needs to exist. Non-employment income does not qualify for this exemption. So those of you that are self-employed, sole proprietors, consultants, freelancers, unfortunately, this exemption will not apply to you. Taxation between the 1.250 million, any foreign income that exceeds that amount, if you apply the exemption, if you qualify for it, will then be taxed according to the normal tax tables in the relevant tax years. Additionally, there is a relief for foreign taxes. If you've paid taxes on income in another country, South Africa allows you to claim a foreign tax credit. This credit is generally limited to the lesser of the foreign tax paid or South African tax payable on that income. That might not always be in full. There are also certain exemptions for entertainers, sportspersons, pilots, and seafarers. Non-residents, if you break your South African tax residency, you will then protect all of your foreign income from SARS, as non-residents are only taxed on their South African sourced income. Let's move on to our second myth. This myth is common, and they believe that if your income is below the 1,250,000 rand threshold, you don't need to declare it to SARS. This is not the case. Even if you qualify for the exemption, you still need to declare your income to SARS and claim the applicable exemption and possible tax credits. All right, let's move on to how we would break tax residency. What is the process? Seizing tax residency or tax immigration, financial immigration, there's many terms, but at the core of it, it is breaking your tax residency from South Africa, meaning you become tax non-resident. This can happen through different mechanisms, either as a one-time event or through an annual assessment, often guided by the double tax agreement. The once-off route, so seizing your tax residency once off. The criteria for once off is very subjective. However, the permanent intent to no longer reside in South Africa is the main criterion. Now, intent can always change. You never know what will happen in life. There was COVID, there was the Ukraine war, there's visa issues in New Zealand. There are many reasons that your intentions have to change. But however, if you're leaving with a permanent intent to no longer reside in South Africa, that is one of the main criteria to be able to break your tax residency once off. It is crucial to inform SARS about the change in residency status, as the burden of proof falls on the taxpayer. In SARS's eyes, unless you tell them or notify them of anything, they do not change it. You have to do it. It does not automatically happen. Therefore, your status will only change once an application is formally made to SARS with the necessary evidence and is then approved. Tax implications. After ceasing tax residency, foreign income will no longer be declared to SARS, but local income must still be reported. Ceasing tax residency may also trigger tax consequences like capital gains tax on asset disposals, so proper planning is essential. The other way to seize your tax residency is an annual basis. Tax residency can be seized temporarily on an annual basis, often through the application of the double tax agreement that exists between your two jurisdictions. The criteria for annual seizing, generally, this is used once you move abroad to live and work there, but will be returning after a set period. You must be able to meet the residency requirements set out in the article of the DTA between your two nations and be a tax resident in the other country. You would need to claim the DTA relief with SARS annually due to the temporary change in residency. Tax implications of this one. Similar to the permanent cessation, annual changes in tax residency can result in tax liabilities like capital gains tax. When using a DTA, navigating the treaty provisions between South Africa and another country is crucial for compliance. Once you seize your tax residency, you will receive a confirmation letter from SARS. Here's an example of the tax non-resident confirmation letter. This document is crucial for proving your non-residency status to other jurisdictions. You can see it states the date at which you seized your tax residency with SARS. That is highlighted in blue. In this case, it was 11th of September in 2016. It is also important to note that it also mentions that any changes in your status must be notified to SARS. The second document is an example of a foreign tax residency certificate. This specific one is from the UK. The certificate can be essential for confirming your tax status in another country when applying to break your tax residency in South Africa. This will be required whether you do it the once-off route or the annual route. You will also need this if you choose to withdraw retirement funds based on your non-residency, which we will speak about a little later. Not all jurisdictions will provide you with this letter. Don't fret, there are other motivations and explanations and legal requirements that we can motivate to SARS. Let's talk about the drawbacks of breaking your tax residency. In South African tax law, Section 9H outlines the consequences for individuals who are considered to have disposed of their assets for capital gains tax purposes when they emigrate. This is commonly referred to as the exit tax. For the exit tax, an individual who becomes a non-resident due to immigration is deemed to have disposed of certain assets at their market value on the day before their non-resident status begins. At the same time, the individual is also deemed to have reacquired those assets at market value, creating a capital gain tax event. It also sets a new base cost for future capital gains tax calculations. The reason for this, so the reason that you're going to be deemed or to have fake sold and fake reacquired your capital assets is that as a non-resident, you're no longer liable for capital gains tax in South Africa, even on South African assets, except for South African-based property and South African property-rich companies. Therefore, SARS wants their part of the gain earned whilst tax resident. Now, not all assets are included in this capital gains tax event, the assets they will consider for it. The deemed disposal will apply to worldwide capital assets, such as immovable property abroad, shares in companies, be it abroad or in South Africa, interest in a discretionary trust, again, abroad or South Africa, cryptocurrency, shares, stocks, bonds. What it does exclude is South African immovable property, retirement vehicles, cash, and any other personal use assets. In some cases, you can plan your optimal date of ceasing tax residency to minimize your exit tax liability. For example, if you only acquired capital assets abroad after you left South Africa, you might want to break tax residency to the date you left South Africa to avoid them being caught in the scope of this exit tax. All right. Further little drawbacks, not as quite as intense as the capital gains tax, are a few such as non-resident banking. When you become tax non-resident in South Africa, not only does your tax status change, but your banking status changes as well. Your bank account will change to a non-resident capital account. They used to be referred as an immigrant capital blocked account, things like that. They were very strict back in the day when the Reserve Bank was involved in this process. However, in 2021-22, the Reserve Bank pulled out of the process and made it a simply SARS process, and then left it up to the banks, so each bank and each of them to decide what they do and how they treat the non-resident account. Now, most banks since have aligned, and they all now allow you access to your local banking services for any local transactions. So you have full online banking access just like you normally would. However, anytime you transact abroad with your local account, you have to do it not on your online platform, but you contact a non-resident banker from that bank. Now, what else the banks are doing is that they do not allow for credit cards or overdrafts on these non-resident accounts. The other restriction that happens is in terms of remitting funds. South African tax residents are subject to an allowance of up to R1 million per annum when transferring funds abroad. This is commonly known as the Single Discretionary Allowance, or an SDA. Non-residents, on the other hand, are obliged to obtain an approval for international transfer clearance PIN, known as the AIT, for remitting any amount of funds from South Africa. This applies to all fund transfers, regardless of the amount, from the first cent. The process to get a clearance certificate is not complex, but it does require documentation of your liquid funds and information on where you will be transferring to. The certificate can be valid for up to 12 months, allowing you to transfer the money at your chosen date, which can be useful when trying to optimize the exchange rate differences. When ceasing your tax residency, you also receive a travel allowance of R1 million the year you break your tax residency. Let's move on to the next myth. Another misconception is that you cannot keep any assets in South Africa when ceasing your tax residency. In reality, you can hold assets, liabilities, a business, no issue at all. There are no restrictions there. You can apply for a home loan, you can finance a vehicle, you can buy a holiday home, you can Airbnb it. It does not matter. Let's talk about the benefits of ceasing your tax residency. The main one, the biggest one, is that there will be no tax in South Africa on your foreign earned income. Right? You will no longer be liable for tax on your worldwide income. You will only be liable for any tax on any South African sourced income. The second one is that if you wanted to withdraw your retirement fund early before retirement, the full encashment of the retirement savings will be possible after being 3 years non-resident. They will be subject to pre-retirement tax rates upon withdrawal. The third benefit is that no inheritance tax. Inheritance can be paid out abroad and you won't face donations tax. Then lastly, we have deregistration from SARS. Formal deregistration, so this is different to breaking your tax residency. It is actually commonly confused. Formal deregistration means you are deregistered as a taxpayer and you no longer have any reporting liabilities or responsibilities to SARS. This is only possible once you have broken your tax residency and all financial ties are severed. So no bank accounts, no assets, no liabilities, nothing left in South Africa. There are other benefits that come with being non-resident as well, such as interest exemptions and other things like that. However, the main thing is that no foreign income is liable for tax in South Africa. Other considerations and foreign obligations when you seize your tax residency. Let's talk about non-compliance risks. Non-compliance with SARS can affect visa status, as it can easily turn into a criminal offense. As well, there are penalties and interest to consider, which are a financial burden. Foreign jurisdiction rates. Be cautious with favorable foreign tax rates to avoid complications with South African tax residency. For example, the Spanish Beckham law will allow you for expatriates to apply to use a lower tax rate of 24%. And certain countries like the UAE do not even have income tax. If you have not broken South African tax residencies, those favorable tax rates would be pointless if you still need to pay tax in South Africa on that foreign earned income. Another thing to consider is when leaving other countries to perhaps move back to South Africa, is that you ensure you cover your tax status properly there as well. For example, Australia also has an exit tax similar to South Africa. They will also look at your capital assets for any gain when you leave. The UK has a split year treatment, meaning you can choose to be a tax resident for only part of the tax year, aligning with your entry or exit from South Africa. If you do not apply such treatment, you will potentially be liable for worldwide income in 2 jurisdictions for the full tax year. Let's talk about returning to South Africa after you have immigrated. It is important to determine your status. Are you resident or non-resident for tax purposes in South Africa? You need to ensure that you're correctly classified with SARS to avoid any tax complications. For example, say you left South Africa 12 years ago and have been living in New Zealand ever since and intended not to return to South Africa. However, due to the visa changes implemented recently in New Zealand, you no longer qualify to remain there. Now you need to return to South Africa. When you return, SARS will question what you have been doing for the last 12 years and why you have not been declaring your foreign income to them, as you are still noted as a tax resident. This will bring about a slew of negative consequences ranging from double taxation, late penalties and interest, and non-compliance. We can help with retrospectively correcting your status to avoid these issues. So it is vital to assess your residency and compliance status with SARS and speak to us about potentially backdating seizing your tax residency. It is important to navigate tests, the residency test. You can plan your return and reestablish residency strategically to optimize tax savings. You can make use of the physical presence test and the ordinarily residence test to plan your new date of becoming a tax resident and potentially save on tax. Speak to us or another tax professional before moving back to South Africa or before making any changes or declarations to SARS. It is also vital to plan how you will break your tax residency with your other jurisdiction and what would be most favorable going forward. Let's talk about how we can help. At Sail International, we offer a range of services, including tax health checks, which can determine your tax residency status and compliance with SARS. We can help with tax residency opinions, which will assess your South African residency and your other jurisdiction status via legislation. We can help apply for the cessation of your tax residency to SARS and formalize your non-residency status. We can reinstate your South African tax residency status. We can help with the application for international transfers, those AIT clearance certificates that allow you to remit your funds out of South Africa. We can help with cross-border tax matters, be it with South Africa or any other jurisdiction, really. We offer a free 15-minute assessment, a free 15-minute call, a chat, where we can talk about your circumstances, see what you're looking for, and then how we can help you. We will send a link for this assessment and a tax residency handbook to all of you for further details later on with the webinar. Right, I think we can now open the floor to any questions you may have. Please feel free to type your questions into the chat and we will address them shortly. Right, let's see if there are any questions. Also, feel free to raise your hand and I can unmute you if you prefer to typing your question out. If there are none, what I'll do is I will answer a few common questions that we get, and we can take it from there. Right, I think one of the first questions I get is, I am not sure. I'm not sure if I'm going permanently. I don't know if I'm going to be there just for a little while. I'll find out only once I'm there. That is not a problem. We can handle the situation retrospectively, before you leave, when you leave, after the fact, but you need to speak to someone and don't make any declarations or things before you get professional advice. Another common question we get is, why do you need to do this process? What if I just leave and no one will know anything? I'm a small fish. I don't have much. Unfortunately, and fortunately, I guess, unfortunately, there is the common reporting standards. There's automatic exchange of information that happens. All of these jurisdictions, they speak to each other. And if you're a registered taxpayer, SARS has the right to pull information from foreign banks, foreign revenue services, financial institutions, that they can get the information out of you. And if they find out you have been earning foreign income and not declaring it properly, there will be a potentially criminal offense. There'll be non-compliance liabilities, interest, things like that. Let's see, we do have a question here. If you give up South African citizenship, do you still have tax residency? Yes. So say you've been abroad and you had to give up your South African citizenship to obtain the new states, for example, in America. It doesn't mean that automatically now you're removed as a tax resident. Like I said, the only way to change your status to non-resident is to apply directly to SARS, and then you receive that non-resident confirmation letter. That letter is very important. So even if you've given up your citizenship, make sure you apply to SARS. Right, one more question. If I go and work in the UK on an ancestral visa, what would my best course of action be? Temporary tax residency cessation or permanent tax cessation? Thank you. That's actually a great question. It's also a common one that we get. People think that they can only apply to break their tax residency once they've gained permanent residency or citizenship. That's not the case. Any visa will do. Any visa that gives you the right to live there. Spousal visa, ancestral visa, work visa. As long as you have the right to live there, you have the right to break tax residency this side. Even if you're actually going to different countries, you might be spending half the year in Jamaica, half the year in Japan, but you're no longer in South Africa. That can still work. To answer your question though, attendee, apologies. If you're going on an ancestral visa, would it be to do permanent or once off? That will depend on your intent and then your circumstances. So if you say to me, I don't want to come back and live in South Africa, then I would say, let's do it the once off. It's clean, it's tidy. You don't have to worry about it every year. If you say, I'm not sure, or I definitely want to go back for retirement, or after 5 years, or whatever the case might be, then I say let's do it annually. So again, it depends on your circumstances fully. So we would assess more than just that, but that is just a simple example. All right. Any other questions or concerns? If not, I think we are comfortable to end it here. Thank you all very much for attending, and please do contact us if you have any questions. Let's set up the free 15-minute call and discuss your situation. Have a lovely
Victoria,
day
there's
further.
something in the question and answer tab.
Oh, thank you, Charlene. I completely missed that. Apologies all. Let's have a look at that. All right, let's see here. Cessation of residency. Can the proceeds of a retirement annuity pension preservation fund be paid to a client's local South African account or only to the Rand blocked account? Very good question. Very important one to note. When you apply to withdraw your pension in full, your retirement vehicle, sorry, in full, because you've been 3 years non-resident, it has to go into a non-resident bank account in South Africa in your own name. It cannot be somebody else's name. It cannot be a resident bank account. It has to be a non-resident bank account. I hope that answers your question. There are many nuances, and that's probably one of the questions that you get is, do I have to change my banking status? It's not really a legal requirement. However, it is a banking requirement. They won't allow you to receive those retirement funds into the account unless it's non-resident and you show them, I have been non-resident for 3 years, because they have to then comply with the Reserve Bank and SARS and all these other authorities as well. Wonderful. Thank you so much. I think, Charlene, I think that is it. HR Talk, Charlene, thank you for hosting us. And thank you everyone for attending. Wishing you a lovely day ahead.